Good morning, ladies and gentlemen. Well, the big news over the weekend was that Moody's joined the other two rating agencies and downgraded the US. So now they're no longer AAA for sure, AA1. And what are the implications? Well, the implications are that term premium and almost by definition, real rates cannot really go down now. This is term premium since the beginning of the year. This is where we started the year, and this is where the 333 plan of Bessent's came into action. He wants to lower the yield of the 10-year note, and he is unlikely to now succeed, especially with this bill that's going through Congress, this one big, beautiful bill, which is going to increase the deficit and keep it high and send it even higher. Are the hawks in the House going to be emboldened by this downgrade? Well, most probably, which actually reduces the odds of the bill going through. So what are the consequences? Well, the consequences are that if anything, term premium has to rise back towards where it was at the beginning of the year. So we closed on Friday, let's call it here, around 60. We've probably got another 10 basis points. And real rates are absolutely unlikely to start going down again. I would have thought they're much more likely to test this 230 level, which was the, what is it, 234, which was the highest level for the year. So I think that there is very little odds now that we start breaking down through 2%. I think it's much more likely that we test the highs of real rates for the year and the level of term premium that we had at the beginning of the year. Now, is this downgrade a disaster? No, because all they've done is joined the other two rating agencies, S&P and Fitch. So it's not going to be anywhere near as important as it was in 2011, I believe, when S&P downgraded the US. And, the reaction is going to be much, much more muted. What I think is more important is that we're now entering this window of potential weakness that I've been talking about consistently. And really it starts now, the second half of May, and goes towards the end of June. If we're going to see weak data, i.e. that the tariffs or the tariff talks or the whatever have weakened the economy, it's going to start showing up in the real data now. The fact that it's shown up in the soft data is neither here nor there. If we're going to get it, if we're going to get a real weakening of the economy, it has to start about now. So next week we have very little data indeed, so it's not going to happen next week, but the timing is now. What is likely to happen to the yield curve if the data is weak? Well, that is obvious. It steepens. It steepens a lot because now you have a double whammy. You have the downgrade in the US, which keeps real rates high and keeps term premium high. And on the other hand, you have a weakening of the economy, and that gives the Fed cover to cut. Now, will they cut in June or July? It really doesn't matter. The two-year note is going to run it, and it's going to run it hard. It's not going to happen next week, right? So next week, the range is probably going to be somewhere between 390 and let's call it 415. That is going to be the range next week. But I'm looking forward to what is going to happen when we really do have weak data in let's call it the first week of June, when we get non-farm payroll and it's down hard. Is it likely? Well, who knows? Probably the odds are way less than 50%. But if that were to happen, you go and retest this 369 area without any problem whatsoever. In the meantime, you are looking to probably position twos as close to 426 as you can, or buy some calls there on the 2-year note. That is the strategy that I'm going to be employing, because I think that bonds are going to be shunned for a bit. And there is a real possibility that if the data does not weaken in the next couple of weeks, where are twos? Well, they're on top of Fed funds, because everyone is saying now, well, they're never going to ease again, not this year. So where would twos be? Well, they would be in this range, wouldn't they? Between 426 and 442. 442 we never traded. I really wanted to get long there, never really got the opportunity. But I think we could have that opportunity, probably not next week, but the week after, to buy calls somewhere around 426 to 430, and then hope for this window of weakness to really open. So going back to the yield curve, I think it's very, very easy to forecast what is going to happen if there is weakness. If there is weakness, we go down to minus 73 in twos, tens in no time whatsoever. If there isn't weakness, it's much harder. I think if there isn't weakness, we could flatten a little bit to around minus 35 or something like that. I think minus 28, certainly in the next couple of weeks, is unlikely. But if we were to see it, that is the level from where it really could steepen again. 530s is completely different. 530s probably is not going to do anything at all over the course of the next couple of weeks, simply because if it's unlikely that the Fed is going to be able to cut rates at any time soon, then fives really should go above twos, and they should be in the Fed funds area, which is around 440 to 449. So fives could go all the way back up to the highs of the beginning of the year without too much problem. The problems are going to be all in the 10s and the 30s. I would have thought that at some stage 458 gets tested, probably, at some stage next week, but it holds. And in the 30s, I've marked this 511 is the highest close that we've had on this move. I think the downside is very, very well protected unless we get this weak data. If we get this weak data, we can go back down to this 470 area and trade around while the yield curve steepens. So the 30s go down to this kind of area, and then they just go up and down, while the twos and the fives do consequentially better. That's not going to happen for another couple of weeks. Do I see 30s really breaking the 5% next week? Tough. I think it's very tough that is going to happen. But what I do see is a continual steepening of this spread, 10s, 30s. I think 10s, 30s over time will break this level, this 51 level, and they will go all the way down to trading in this area, which is minus 78, minus 80. I think that's a purer play of the steepening of the yield curve and also of term premium. I think 10s, 30s are going to keep on going down and down and down. This downgrade of the US, there will be rather a reticence of people to extend duration. A lot of asset management companies have rules about investing in AAA only. They will have to change those rules because there is no other market that can take the size. But that takes time. And also what it does, it makes them shun the longest duration. They will definitely shorten duration. And anyone who's investing in 30s will probably start going towards 10s. So I think this 10s 30s is much more likely to be the part of the curve that reacts to the downgrade over time, and that we get this move down by another 30-40 basis points in 10s 30s naturally over time. For the long-term investors, what is interesting to watch now is TIPZ and TIP. If I'm correct and that real rates will stay high and go higher and the term premium will be high, then TIP over TIPZ, which is this one, will continue to go a lot higher. But what is interesting is TIPZ. If you go all the way back to 2010, when it started, this is when these are the lows. Now, this is my theory. My theory is that the US economy cannot take 30-year real rates at 3%. So at the moment, real rates are just north of 260, let's call them, on the 30. If they get to 3%, I think anywhere between 285 and 3%, which is going to be down here, is just about all the US economy can take without really going into recession. I have decided that if we see these levels down here below 50-40, I have no alternative but to put my money all into reals and sell all my risk, because I think that that is such a harbinger of recession. It's not true. Either recession or they're going to inflate their way out of it. So in either case, real rates are going to do well, because if they inflate their way out of it, fine, I'll just pick up 3% real on a much higher inflation rate. That is the way I'm thinking about it. There's absolutely, I just can't see an alternative to A, real rates staying high and possibly going higher, but also once they've gone high enough that they're going to basically send the economy into recession. 3% real on 30s. I don't think there's a project in the United States, apart from tech, of course, that can withstand that kind of hurdle. A 3% real hurdle, but that's enormously high. And that's why I think that if we see TIPZ, which I'll be looking at very closely, TIP has much less duration than TIPZ, and therefore it's a completely different chart, and that is why you're getting this. That is why trading, being long TIP and short TIPZ, I think is a very good trade, and that brings you back to 10s 30s. That is the same really as 10s 30s, and you can see the direction of travel. In Germany, the situation is much the same, but nowhere near as extreme as in the US. Even if they were to stop cutting rates in Germany because there is no weakness, where is the Schatz going to go? Well, it's really not going to go much further than this 210 area. Is there a decent chance that we revisit these levels? Yes, but it was not going to happen next week. The one that is really going to benefit in terms of reallocation probably is going to be the Bund, because it remains highly rated or higher rated, and that means that there is very little likelihood in the week ahead that we start busting higher, and really the spread against the US should start coming in. So I think there's going to be a period of stability, but every time 251, 252 trades, I think the odds are that you buy puts on the Bund, because eventually it's going to go back up. I have very little doubt of that, because really the yield curve is going to steepen again. And let's give you the 2s10s. I'm absolutely sure that the yield curve is going to go and trade around 127 in the 2s10s at some stage this year, and that gives you another 50 basis points of steepening. So for the time being, the Bund is going to be favored, and that's probably why we saw the little bit of a rally on Friday. Somebody knew, somebody always knows, and they basically switched allocations into Bunds. I don't think it goes very far. As I said, 252, I think it's a wonderful level to buy puts, put spreads, whatever you like, and be bearish on the Bund. If you look at all the other spreads, for example, Germany and Italy, Italy is basically the poster child at the moment, because everybody wants the pickup in yield. When people want the pickup in yield, it means that they can't see much juice in the Bund, and I can't see it either. So it makes sense to me that this spread should keep on going down towards the all-time lows, which are around the 90 level. If you look at Germany, France, this is telling you that having reached a new level, they consider Germany and France as bad as each other. So unless this starts breaking down hard, and I think the odds of that are now very, very low, and Germany is as bad as France, or France is as bad as Germany, the odds are that at some stage yields move higher, not lower. Those are the odds, and those are the ones that I'll be playing. If I see 251 next week, I am a buyer of puts. The tell next week should be the US against Germany. If all we can do is trade around this 190, 192 area and really not start busting higher towards 202, that's going to be a tell that the real rates in Germany are too low to move this much further. And then I do believe that the Bund is going to be very, very vulnerable to moves higher in yield. Because if I'm correct in my thought that real rates in the US are going to move higher, and then you get a choice between investing in the US dollar at, let's call it close to 3% real rates in 30 years, or let's call it 260, 270 in 10s, and investing at 50, 60 basis point real in Bunds or in Germany, why would you not pick the US? I just can't see a reason. I think that kind of spread is going to be very, very attractive indeed. And if that were to happen, then Bunds themselves are going to have to move 40, 50, 60, 80 basis points higher in nominal yield to start offering a better real yield. So I think that is likely to happen. And that is why I just can't see any reason one would want to be long of Bunds, because at some stage they're going to start breaking up in yield quite hard. And this is going to be the tell next week. If all we can do is really basically trade here without any impulsion, to me that tells me that that level in Bunds that I just mentioned, around 250, is a very good level to get short. The dollar last week did exactly what I thought, which is go up no higher than 101.90 and remain in a range between just below par and 101.90. What is that, a 2% range? And I think it remains in that 2% range for a while longer. I think it's going to be very, very hard to bust it through par sustainably. And I really see no reason why it should start going up through 101.90. It's going to remain in this range for a bit, but then I think the direction of travel is south. I'm pretty convinced that the administration wants to weaken the dollar. And if you think about it, if you're not raising a huge amount of money through tariffs and you're doing deals left, right, and center, the only way to get the manufacturing back into the US is going to be via a lower dollar. How they're going to achieve that lower dollar with high real rates is beyond me. Well, the only way would be to, tip the economy into recession. So how they're going to do that, I don't know. But I'm pretty convinced that given the choice between, trading at 110 or at 90, the administration would pick 90. How they're going to achieve it, again, I don't know. But I'm looking for any kind of hint or sign that they're going to do it. And I think it's much more likely that they do it, but it's not going to be imminent. It's not going to happen in the next few weeks. What would really hit the dollar would be if this window of weakness that we are entering actually turns out to be a real weakness. Then I think people would really start selling the dollar. As I suspected last week as a result of the China deal, and let's face it, do we even know what this deal is? No, we don't. No one knows, not even Besant knows if there's a deal. What we do know is that they've lowered the tariffs on China as a sign of goodwill to make a deal. Well, if they don't make a deal, what happens? Do they up and back up to 150%? I mean, who knows? Basically, it's just a whole load of punting into the future, and let's hope things carry on without collapsing. But the response was quite clear. Sell gold, buy risk assets, and therefore you got this move, GLD over SPY, which was the obvious move. Where do we go to? Well, we might go a little bit lower, I don't know. I doubt we go very much lower, but we are ready to continue a move higher. So if we go back to gold, what is likely to happen is that these kind of levels are likely to hold, 31.20, 31.30, 3100, and then we get a move back up towards 33.47. Gold is your natural refuge away from bonds, right? If you think that bonds are, still the grading is too high, let's say. I don't know what to tell you because it's rubbish, right? But, is it likely to happen anytime soon that the US gets downgraded again by S&P? I think that is very, very unlikely. So when I say S&P, I mean back to 2011, and then the cycle starts again. So it's S&P, Fitch, Moody's, S&P, Fitch, Moody's. Is that likely to happen? No, it's not likely to happen. So wherever gold is now, it's more likely to rally than start going down again. So I'm going to be a better buyer of gold on these dips. What really surprised me last week is that GSG couldn't do anything at all, right? I mean, it had every opportunity to rally. It didn't do it, which tells me that this market, the commodity market, is still worried about this window of weakness, which is opening up in the next month and a half. I don't know how else to explain this, because if real yields are going higher, if the economy is doing great. Why would commodity prices still be in the same range that they've been since 2022? I just can't get it. We've had a whole load of inflation, so these producers have accepted much lower real prices, and we're just not going up. I would have thought that we'd start breaking 22.93, but we're not, which tells me that there's a chance that this economy is going to be weak, or that real growth is going to be much, much lower than the stock market is discounting at the moment. I'll keep on watching it, but I'm quite surprised that this isn't doing better. I wasn't surprised that BTC did not a lot last week, for the same reason as gold was sold in favor of risk assets. And I told you last week that I thought that BTC would get swapped out for risk assets, i.e. equities. So really all one can look for is a break outside the highest weekly and daily close. The highest daily close is 1,000. You can see here 106,235. If you start getting a weekly close above there, that means that we are going to spike these levels and continue on our merry way. I think it's unlikely to happen in the next week or two, and you can see how volatility is getting compressed here. So this compression tells me that either we're going to go and test hard this 92,000 level and try to stop everyone out, or, having flagged here for another few days, we're going to go and test the 110 level. I'll tell you which when I know it, but this really should continue. This EBIT over SPY should continue to compress here for a few days and then try to retest these highs. I don't think that either gold or Bitcoin is ready to start breaking out just yet, but I think the direction of travel in Bitcoin at some stage is going to be to spike these levels, because this compression to me is very telling. When we had the first downgrade, the stock market gave up 10%. It's not going to do that now. I was very surprised that we were able to take out this 58.65 level so easily last week, and then used it as support for the rest of the week and bounced and closed at the highs of the week. While 58.65 remains the support, I think we are likely to trade sideways. I don't think that the stock market is going to get very hit by this downgrade. If we lose the 58.65, the 57.65 level remains as big support. That is absolutely the lowest that I can see it, but that is going to be a good level to buy both calls and puts, as it were, i.e. straddles. From here, it's either going to go all the way back up and test, as you can see, the highest monthly close is 60.40. So either it's going to go all the way up to 60.40, or it's going to do something for a very different reason, i.e. the window of weakness actually does open and we go probably all the way to 52.50. So at that level, I am a big buyer of volatility, because I think volatility is, or rather straddles, because it's going to move a big, a long way from here, because either we're going to go all the way back down or all the way back up. As you can see, the highest close, monthly close at 60.40, the highest weekly close actually is here at 61.14. We're going to go and either test those, or we're going to go all the way back down to these levels, 56 something, or even lower down here, 55.50. So those are my preferred levels. If we go to the clean chart, which is the easiest one to see things, you can see how difficult it's going to be to make the new all-time highs. But I think that once we've retested these levels, I think that we're going to go again. So it's, does the window of weakness open? That is the really, really big question, which is not going to be answered next week. The chart that is slightly different is NQ. We are now at the highest monthly close. Okay, we might back off a bit, but I don't think it's going to last. I think this chart is more likely to go up than down, and therefore I'm a buyer of the spread between the SPY and the Nasdaq. And let's have a look at that. Here you have QQQ over SPY, and you can see last week it went up quite nicely. It's at, very good resistance levels up here, so it might back off next week. But let's try to figure out why this spread should break higher. If I'm correct in my thinking that real rates start going up, the term premium go up in bonds, and things like 10s, 30s start going out, and you have a situation in which real rates are really killing the economy, or you have a very high hurdle rate for new investments, it makes sense that the only one that can go up or do better is the one where the returns are the highest. Now, towards the end of the week after this one, I think it's the 28th, you get Nvidia earnings, and that could, have a major role in the short term. But I think over the course of the rest of the year, the likelihood is that we break this range between 83 and 89, and we start going up in QQQ over SPY, i.e. favoring the Nasdaq over the SPY. Well, volatility did exactly what it should have done on Monday. It opened below the 2060 area and really closed on its lows. It's going to open higher for sure, but if all it can do next week is fill this gap and really not threaten this 2280 area at all, then we know that the correction has no depth. And those levels that I indicated in the S&P are really going to be key supports, and from there you can probably get another leg lower in volatility, which would tell you that the market is going to go towards new highs, i.e. no window of weakness. It's basically going to be either a big window of weakness or no window of weakness. It's beginning to be somehow either one or the other. So it's going to be telling, because if there is no window of weakness from the tariffs episode, that would enhance my argument that you get a move higher in real rates, real long-term rates. And if you get a move higher in real long-term rates, that eventually is going to kill the economy, as I try to explain. I think there isn't a project outside of tech in the US that can withstand 3% real rates on 30-year bonds. And that then will spike the volatility upwards when that happens. But that is probably many, many weeks away. So how does it work? Now we're looking for a window of weakness which was caused by tariffs. If that doesn't open, the stock market goes up, volatility comes down, and then you get the move in the 30s real rates, And that then spikes volatility and kills the stock market. So it's either does it happen in the next month and a half, or does it happen towards the latter half of the third quarter kind of thing. To me, in either case, one of those things happens. And I'm watching, as I told you, real rates. I'm watching TIPZ. I'm watching TIP. I think that that will happen, probably more likely to happen rather than that this window of weakness realizes and that the economy goes into recession as a result of this tariff episode. I think it's much more likely to happen because of what happens to real rates. So what will I be looking at next week? Really 58.65, if that gives way, then I know where it's going and I know what I want to do, which is buy straddles when it gets to the next support. And that is it. I want to be watching bunds as well to see if they get to 252, because especially if you don't get a big move in 10-year US Germany, that is the level that I want to get long of yields, i.e. short of futures in the bunds, and I'll be doing put spreads and I'll be tweeting to you about it. I think now it's beginning to be binary. Is the weakness window from tariffs going to open or not? It's not going to happen next week because we have no data next week, but this is it. This is that window. And is it going to be enough? I doubt that it's going to be enough, and therefore I think that it's much more likely that equities perform well, and especially the technology sector, as I've explained to you. But then I'll be watching reals. When reals get to the 285 to 3% area in the 30-year note, I want to be a big buyer of those and getting out of risk assets. Thank you very much indeed, and tweet you tomorrow.